Today, I'm going to build us a financial plan live to see how hard it might be to retire or how easy it might be to retire at age 40. Time to think like an investor. Hello and welcome back to the channel. If you're new here, my name is Josh. I am a 7th year certified financial planner, and today I want to build a financial model for us live. You see, it was about 2 and some years ago that I started making YouTube videos, and one of the really cool things that happens when you start putting content out there, I'd recommend it for any advisor or anybody in any career. The serendipity that comes your way is really weird. I had the filmmakers for an Amazon Prime documentary reach out to have me talk about the FIRE movement.
Financial independence to me is just a type of freedom.
Instead of having to trade time for money, I can accumulate enough capital so that I don't have to work.
When we think about investing, that's 3 major asset classes. Stocks, you have a share in a company. Bonds, you're giving loans to different people, whether that's the government or a business. Or
this whole idea of financial independence, retire early. How little can we spend now and save as much as possible so that down the road, we can retire very early? And so as a certified financial planner, it seems to me like there's a lot of risk inherent in that, right? If we have less time to save and have to live off of those savings for longer, that's actually going to be detrimental to like the typical retirement projection. Not only that, we have less time to wait out the market fluctuations and bad sequences of returns. If we have a really high period of inflation or a really big crash, we have less time to overcome those things in our financial trajectory, right? And so as I was being filmed for this Amazon Prime documentary, I was thinking to myself, I have all these preconceived notions of FIRE, not the hugest fan, but I've actually never tried modeling it out for someone like my audience or for someone like me. So today we're gonna take a 26-year-old who makes, say, $80,000 a year, and we're gonna see how hard it would be for them to retire at 40. What I'm using is a financial planning software from Canada particularly, but we can easily convert these to US numbers. And so what I'm gonna do is I'm gonna call this Josh's biggest fan is entered the chat, and his date of birth, 1996. We're gonna go in the province of Ontario because no matter where you are in the world, you've probably heard of Toronto. We're gonna assume this person is single and they're just getting started at 26. Starting year, we're gonna start this in 2023 because it's almost 2023, and by the time you're watching this, it's probably 2023. So retirement age, this is where we're really gonna hammer things down. We're gonna say age 40. Show projections and tell. Okay, so this is tricky, right? We have to think about life expectancy. How long do we think Josh's biggest fan is going to live? Well, you're probably healthy, you're probably in the gym, you probably played sports, you're probably dieting somewhat decently. Let's be reasonable, because we could make this argument that science is gonna come in and make us, all live to 150. No one's retiring at 40 unless they create some AI that creates an income for them, and then they don't have to work anymore, which is, actually not that out of the picture. But all I'm saying is, when we think about retirement, we think about, doing it within the bounds of normal life. And so let's go age 40 to 90. We got 50 years, okay? Inflation. What do we use for inflation, right? Okay, so I think it would be safe if we're gonna be the kind of person who wants to retire at 40, we should probably do it building in a bit of a margin of safety or a buffer. And so usually people might use 2%, 2.5%, we're gonna use 3. We're gonna assume that inflation from 26 to 90, whatever that is 3%. The rate for our pension plans, our government pension plans, that might be Social Security, what do we call it, Canada Pension Plan. The rate of inflation for old age security, Canada Pension Plan, are gonna be 3% as well. What can we assume for rates of return on different types of investments? Okay, so this actually brings up a lesson in terms of financial planning and as advisors. The assumptions you make can a lot of the time just be little cells you plop in, but the reality is the assumptions you make are actually more important than the plan itself, or just as important. If we create insane assumptions into here, we can make any plan look easy. And so we have to use realistic assumptions. That over the last 100 years, the stock market's done about 11%. Should we base our future expectations on that? No. So I'm gonna actually just keep it at 8. Fixed income right now, 10-year treasuries are in the 4.5% range. Let's keep those at 3, and return on cash is 1. So we're kind of assuming a low rate paradigm here, where stocks do a little worse than they have over the last 100 years, and rates are kind of low. Big assumptions, right? So this is one of the big caveats in financial planning or modeling is we're making assumptions, and we need to make sure that those assumptions are reasonable. Employment income, we're just gonna make this super simple. There's no corporations, there's no side hustles. This is someone working, salary income, 80 grand a year. It's taxable. Do they have a pension? That's a big question, right? So in terms of retiring at 40, it's gonna be a lot easier if you're on a teacher's pension or a nurse's pension than if you're self-employed and you have no pension at all. For now, let's assume there's no pension just to give this the benefit of the doubt. Most pensions are really gonna hurt you for like retiring that early anyways. And so we're just gonna move on with these like really simple scenarios. Assets. Let's assume that Josh has, I would hope if you're 26 years old, and this is like really making an assumption about people and that sort of thing. I would hope by 26 years old, if you're interested in finance and you're watching this channel, you probably got 50 grand saved. That might be a bit of a reach. Some people have student debt, all these sorts of things. You know, if you don't have 50 grand saved by the time you're 26, you're probably not thinking too hard about retiring at 40. You're probably thinking about other things. We're gonna say as of now, we are investing in 100% equities. If you want to retire that soon, doing that with a GIC or a balanced portfolio, it's just not gonna happen. And so we probably have to have 0% cash, 0% fixed income, 100% stocks, and we're gonna create 3 different accounts. We're gonna create our tax-free. That would be like the equivalent of a Roth IRA. We'll create a tax deferred. That'd be the equivalent of an IRA, and a non-registered, which is like just, you know, where you put money when you've maxed out all of your accounts. And we're gonna say that so far this person has split, We're gonna say so far this person has split 25,000 into each of those. For us, Roth IRA is TFSA. For us, IRA is RSP, and non-registered will just be a non-registered. Now we can go into each of these accounts and build in different assumptions. If you are 26, you have, don't crucify me for this, finance YouTube, $75,000 worth of TFSA room. They've already put in 25, we're gonna have this at 50. Next, we have RSP contribution room. This is equivalent of how much you're allowed to deduct going into your IRA. The person's been working for 3 years, 18% of income on 80 grand, call it probably 20,000 in there. It's about 20,000 of room, and they're accumulating an additional 20% of 80 grand every year. So like, you know, 16,000 bucks. All right, now in terms of pensions, is it fair to assume this person has like some sort of employer match? I think that it is fair to assume that. I think if you're thinking about retiring at 45, you're probably maximizing all these little things. Probably would imagine that this person has a group plan, like a group IRA, a 401k, or like a group RSP that their employer is contributing to and matching, and they can, you know, match and that sort of thing. And so we're gonna assume 3% on one of those, because like without that, again, I don't think you're thinking about retiring at 40 if you don't have some sort of thing like that. We're gonna assume Josh's biggest fan has no debt. You wouldn't be thinking about retiring at 40. So, can you even start CPP at 40? Absolutely not. You can only start your government pension 5 years early. Annual retirement pension, if you're retiring at 40, that means you're not going to accumulate the same amount of credits that you would get if you were retiring at 65. So let's go, 65 is the average career, minus 25 years is when you start your career. So 40 years of working lifetime. If you are only going to work 15 of those, that means that you are only working about 37.5% of the average person's working lifetime, right? And so what I'm gonna say is I'm gonna say probably on the high end, 37.5% for somebody's government pension that kicks in at 65. You know, the thing about old age security, the way it works in Canada, is that you just get credits for every year that you live in the country. And so we can't make this any earlier, but what we can do is we can get the full benefit, because as long as you've lived in Canada for 40 years, you get the full benefit. So we'll call that 100. You guys hanging in there? Is this boring? Trust me, we're gonna start modeling stuff out. It's gonna look fun soon. We just gotta enter our assumptions a little bit. We're gonna assume no insurance policies. No need for that right now. We're not gonna do this like Freedom 25, whole life insurance policy. You figure it out on TikTok, blah, blah, blah. 1 or 2% of people get richer with life insurance policies. And it's usually if you own a corporation and a holdco, and there's a lot of things you're trying to do with your estate and you have it for other reasons. Don't fall for this like life insurance is an investment type of thing, unless you have an incredibly niche situation and you have an advisor that you trust like 10 out of 10 and they're saying maybe you should do this, okay? That's all I'm gonna say. We're going to assume no kids, no education we're trying to plan for. We're gonna assume no corporations. There's no corporations involved in the picture. How much of the portfolio is capital gains versus dividends versus foreign dividends? You know, I don't hate this split to think that this is gonna be 60% capital gains, 40% income. That's pretty standard across like a growth portfolio. And that breakdown between Canadian dividends and foreign dividends is also pretty standard. And let's take a look at advanced. We're not gonna, if you're retiring at 40, are you donating to charity? Moral dilemma, isn't it? So now the great thing is we've built out a set of assumptions, and our software, which is lovely and high leverage, is going to create this wonderful projection for us all the way down until the end of time, until we die at age 9. We have over here the after-tax spending. Let's ignore this entire thing for now, okay? We're trying to think about what kind of assets are we accumulating, our capital assets in our different accounts, and we are thinking about what is our retirement spending gonna be down here. Shall we get started? Let's do it. First things first, you are making $80,000 a year and your employer is already contributing $2,400 for you and you are matching $2,400. If you're going to be retiring at age 40, you better be saving a quarter of your gross income. So let's imagine we're gonna do $20,000 per year. The nice thing about this software is it'll let me know when I've maxed out my tax-free room on the savings account. So I'm just gonna copy this down until retirement age, and it's at 20,000 now, but the second I press run scenario, the computer's gonna crunch for me. Well, actually you're gonna max it out before then. So sure enough, I max it out around here. And so I'm gonna max this out in my 4th year. The rest of that 20,000 can get funneled into my IRA or RRSP. And so what I'm gonna do is I actually have to go and create a new RSP because the other one is the one my employer is contributing to. And so I'm gonna go add a capital asset. We are going to add an RSP. This one's gonna have $0 in it. We're gonna do it this way. We're gonna put that $25,000 into an RSP down here, and that is also gonna be invested at 100% equities. I can hear all the FIRE people being like, oh, 8%, that's not realistic. I can get way more than 8%. I can pick great stocks. I don't care about what you think. No, you can't, okay? Let's be honest, you can't. And so what we have now is an extra RSP with 100% stocks in it. We are investing all 25% of that gross income that we're saving into TFSA for these 3 years. Then it goes down to 10. So we have $10,000 left over to contribute to our RRSP. 80 grand is like right on the borderline of whether it makes sense to contribute to RSP or not in most cases, right? Most cases. And so what I'm gonna do is I'm gonna say 10,000 in this year. We're gonna put that into RSP. And then we have 13,000 every year thereafter. But hey, the software is gonna do us a big favor. You're gonna run out of RSP room at some point. You know, you can't just contribute 13,000 every year. It's not gonna work that way because your employer's contributing and you're contributing, you're gonna hit your maximum. And so I was totally wrong. All right, so what we're seeing is that we are now having our employer contribute $2,500 a year into investments that accumulate at 8%. That's creating a tax deduction for us because it's an RSP. It's a tax deferred account. That's getting added up in these total tax tabs and getting kicked back to us as a refund. We are now saving $20,000 a year until we max that out and then just saving the yearly maximum. And then after that, we're kicking that leftover money over here into this account and saving the yearly maximum. Where do we get to at age 40 if we've been accumulating money at an 8% rate of return at this level of savings? $351,000 in our TFSA. We have $111,000 in our group plan, and we have $270,000 in our personal RSP. 270, 111, 325. This means we have accumulated $706,000 in our accounts in that period of 15 years. That's pretty good, but it could be so much better if we just let it compound for longer. But let's use that 4% rule that all financial advisors hate and everyone think is a massive oversimplification just to get us an idea. 4% means we could now live off of $28,240 a year. But now there's major risk associated with that. What if inflation runs hot for 10 years between when we're 60 and 90? Right? There's a lot of risk in a plan like this. What I want to do is have the machine learning or the AI part of this software figure out what we can now live off of given tax rates, given different income brackets, given different inflation rates, all these different things that we'd have to drill in on to figure out, okay, how do I get that 704,000 to sustain me from 40 to 90? How do we do that? Sustainable spending from age 40. We're gonna calculate. So the machine's gonna crunch this for us, and it's gonna tell us what we can potentially live off of. Okay, so it's a little bit less than the 4% rule, okay? And so here's a good example. If you had been using the 4% rule and you had been off by a little bit every year, those add up, and now you're like 75 years old, you don't have any money left, and you were trying to get to 90. So these oversimplified heuristics can do a little bit of damage. What we're saying here is that we can have an inflation-adjusted, after-tax, $26,000 a year to spend. So what I'm gonna do is I'm gonna hit copy before applying. And so we're gonna apply and run and copy that. So now we're creating a standalone version of that model and then copying a new one so we can make some adjustments without wrecking the first one. Let's take a look at a visual here to see where we're at. let's take a look at a chart. And so as we can see, Josh's biggest fan accumulates like a madman for the first 15 years, and then the investments grow enough to actually continue growing while we're withdrawing, right? And then what happens is towards the end, when we would start withdrawing more principal than interest, and we start withdrawing more than our investment gains each year, we start to see this really quickly decline down to age 90. But the reality is, if like 26,000 is enough for you, it's doable. It's just really risky. And so the reason it's risky is we don't know what happens over those remaining 60 or 50 years of your life. 26,000 means you could spend $2,166 a month. You could retire in the Philippines with that amount of money, right? Now, let's think, how much money would we have to save to have more of a reasonable living? Let's say you need at least $40,000 a year to feel like you've actually got some sort of retirement income, to feel like you're actually like living at least a little bit. You need a lot more than that. We're gonna reverse solve for 40 grand and copy this down to 90 and say, okay, how much of a deficit do we come to? How bad does this get if we try to withdraw 40 grand? Well, how bad it gets is we run out of money at age 54. So 14 years into our plan, we're already in the negatives. That's what that red shows. We're accumulating a massive deficit. We're $9 million in debt by 90. Not great for someone earning 80 grand. What the AI can do for us is it can find out, okay, well, how much would we actually have to save in order to make that a reality? And so we look at the required savings. The AI machine learning crunches the numbers for us, runs through a bunch of scenarios. And what it finds is, we only have to save $20,000 a year to make that happen. Oh, it wants us contributing $20,000 above what we were doing. Okay, is this possible? What is our net income after taxes? Our net income after taxes would be $80,000 minus $10,000. Why is it so low? It's so low because we're contributing so much to tax deferred accounts and we're getting those deductions back. 70,000 minus, what did we say? 47,500. 70,000 minus 47,500. We would have to live off of $22,500 per year now to make that happen. And so I want to add one more idea. What if somehow Josh's biggest fan can create a YouTube channel that maybe pays him $12,000 a year for the rest of his life, but it only starts kicking in later on? This is the whole idea of a side hustle. What if you have a side hustle that can make you productive while you go through this whole early retirement thing, right? If I have a side hustle and it's gonna start at $0, we're not gonna structure it as a corporation for the sake of time and simplicity. We're just gonna say it's other income. And yes, it is taxable. It's eligible for deductible accounts. And we are going to go save and go back to our model. Okay, so what we have now is the same situation as before, but we've added a side hustle that can sustain us for a long time. Maybe the assumption is we can create content forever, but probably at like 80, you're probably tapped out from like having your side hustle. And so our side hustle is gonna take 2 years to get off the ground, but then it's gonna pay us $1,000 a month, and that's gonna grow with inflation. Maybe it grows even a little faster than inflation because new media, creator economy, all these cool ideas. And we copy that down until age 79, because 80, we're calling it quits. There's just no way. And so we're going to run this scenario and see what comes out. So now we have an extra $1,000 a month in income we're creating from some side hustle. I think a lot of the people in these FIRE movements have some sort of side hustle or some other way to make income besides just their income. A lot of those people make a lot more than 80 grand, right? And so, all right, so what we see now is we have our side hustle income, and that is growing. And the nice thing is that after we quit our $80,000 job, that sustains us. It at least, adds a little bit of money every month. These numbers look high, but really after inflation, they're not nearly as high as they look. This number over here is adjusted for inflation. And so what we're gonna do is we're gonna go back to our little machine learning piece here, and we're gonna say, okay, what can we do now that we have a side hustle? What does our sustainable spending change to? Maybe it's not 40 grand from 40 to 90 now. Maybe it's higher. It's 50 grand, all right? Well, almost. But the nice thing about that is now we're living off more in the present because we have this side hustle that's adding to our income, right? And so instead of just having to live off of like that 22 or 25 grand a year, now we have more like 37 grand a year that we can spend, maybe a little less after tax, right? So I think the reality here, guys, is that if you have a side hustle outside of your 9 to 5, if you are willing to take on some big risks and, build in a really large margin of safety. It's risky, but it's possible. The biggest things that scare me about the situation is the sequence of return risk. What happens if there's like a terrible period of years right after you retire? From like 40 to 50, we have like a Great Depression event. You're gonna have to go back to work. Now you're gonna be out of the workforce. You're gonna have to find a way to get a new job at the worst possible time. That's just like one big risk. And then we can think about, well, okay, your side hustle goes away, now what? The thing that scares me about FIRE is that you're stepping away from being resourceful and you're losing that ability to like work in a real job. And back to this whole thing about charity, what if there's something you want to donate to or a cause you care about, but now you just don't have the money because you have to nitpick every single year to make your plan work out? I think the optimal way to retire early is to work on a side hustle in your 20s, in your 30s, so that by the time you get to 40, maybe you can run your own business in a way that it feels like you're retired. That's probably a better idea. That's probably something more practical. And with the internet now, if you have enough determination and you're willing to be patient enough, you can do that. The idea of saving up capital in these tax-deferred accounts and investing them for the long haul, and then retiring for 40 years only after having saved for 15, possible, but risky. And lastly, if you're interested in these sorts of things or you're an aspiring financial advisor, maybe you're in the business already, I'd highly recommend you check out the Advisor Secrets newsletter, where I drop little tidbits of wisdom on how I became a successful advisor at a young age. Every single week, you'll get my updated tips and tricks on how to push your career forward. So anyways, guys, thanks for watching this video. We will see you in the next one.